The market is currently closed. As of the final bell on Friday, November 21st, Rezolve AI, trading under the ticker RZLV on the Nasdaq exchange, closed at exactly $3.05 per share. The aftermarket action showed a slight tick upward, hovering around $3.06, but for all intents and purposes, the $3.05 level is the psychological and technical anchor we're working with right now. This price point represents a volatile day where the stock swung from a low of $2.84 to a high of $3.18, capturing a massive amount of intraday indecision. While the broader indices were busy digesting the fallout from big tech earnings, Rezolve AI was fighting its own battle to hold the $3 line, a critical zone that separates investable assets from the penny stock wilderness in the eyes of institutional algorithms. The expectation for a company like Rezolve AI, a seemingly obscure SPAC merger that only recently hit the public markets, is that it is just another vaporware cash grab, a company with a flashy slide deck and zero substance that will inevitably drift toward zero as the initial hype fades. That is the standard narrative for 90% of the companies that came public via special purpose acquisition companies over the last 3 years. Investors expect volatility, they expect dilution, and they expect disappointment. But the reality of Rezolve AI is significantly more complex and, frankly, far more interesting than the typical AI hype narrative suggests. The reality here is that we are looking at a company that has somehow managed to secure deep, structural partnerships with both Microsoft and Google within weeks of each other, validation that usually takes small-cap tech firms a decade to achieve. While the market treats this like a speculative gambling chip, the underlying infrastructure suggests it might actually be a dormant giant in the retail technology space. This massive disconnect between the SPAC trash expectation and the enterprise infrastructure reality is where the opportunity and the danger lies. To understand why this stock is trading at $3.05 and not $15 or 50 cents, we have to strip away the noise and look at the mechanics of the trade. Friday's session was brutal for the tech sector at large. When you have NVIDIA stock showing weakness despite crushing earnings, it sends a risk-off signal that ripples down to the smallest players. In this environment, capital flees from speculative growth and hides in safety. You see this behavior clearly if you track flows in Schwab Intelligent portfolios or look at the defensive rotation in Fidelity mutual funds. The algorithms that run these massive online investment platforms are programmed to cut exposure to high beta names like RZLV the moment the VIX spikes. Yet Rezolve held its ground relatively well. The volume on Friday was over 14 million shares, which is nearly equal to its average daily volume. This tells us that despite the fear in the market, there is a dedicated bid stepping in every time the stock dips below $2.90. Someone is accumulating shares in this zone, absorbing the selling pressure from retail traders who are likely panic selling on their Robinhood app. The core story here isn't about the stock price today, it is about what Rezolve actually built. Most people hear AI, and they think of ChatGPT writing poems or Midjourney making art. That is generative AI for content. Rezolve is building generative AI for commerce. They call it the Brain Suite: Brain Commerce, Brain Checkout, and Brain Assistant. The problem they're solving is the abandoned cart. In the world of online investing, we obsess over efficiency. But in the world of e-commerce, inefficiency is rampant. Over 70% of digital shopping carts are abandoned. People find a product, get confused or distracted, and leave. Rezolve's tech sits inside the retailer's system and uses AI to actively converse with the shopper to close the sale. It's the difference between a passive website and a talented sales clerk who walks up to you and asks if you need help finding the right size. This is a specific revenue-generating application of AI that differs wildly from the vague promises we see elsewhere. This differentiation is exactly why the Microsoft partnership matters so much. This isn't a fluff press release. Microsoft is incentivizing its own sales force to sell Rezolve's solution to their massive global retail client base. When you're a small company, you can't afford a global sales team. By plugging into Microsoft Azure and getting co-sell status, Rezolve effectively rented Microsoft's army of salespeople. If you're sitting at home managing your individual brokerage account on E-Trade or Interactive Brokers, it's easy to miss the significance of this. In the enterprise software world, a co-sell agreement with Microsoft is the holy grail of distribution. It means Microsoft reps get paid to sell Rezolve. That aligns incentives in a way that mere technical partnerships never do. But let's pause for a second. I want you to comment below with your thoughts on the current state of retail. Do you think AI chatbots actually help you buy things, or did they just annoy you? Be honest, because that consumer sentiment is the biggest risk to Rezolve's thesis. Drop a comment down there. Now let's look at the volatility through the lens of the retail trader versus the institutional player. If you're using SoFi Invest or Robinhood stock trading platforms, you're seeing RZLV move 5 or 10% in a single hour. This looks terrifying. It looks like instability. But if you zoom out, this is characteristic of a price discovery phase. The stock is new to the public markets. The lockup periods for early insiders often create fear of a dump, which suppresses the price. However, we have to look at the recent news regarding their acquisition of GroupBy. This was an all-stock deal valued at roughly $55 million. Why does this matter? Because GroupBy brings data. GroupBy's platform powers search and discovery for major retailers, processing roughly $30 billion in annual spend. By acquiring them, Rezolve didn't just buy revenue, they bought the training data for their AI. In the age of AI, data is the new oil. Tesla stock is valuable because of its miles of driving data. Apple stock is a fortress because of its user behavior data. Rezolve is trying to build a similar moat in retail transaction data. The comparison to other market favorites is instructive here. Look at SoFi stocks or the fintech sector. They spent years burning cash to acquire customers. Rezolve is trying to skip that cash burn phase by partnering with the incumbents, Microsoft and Google, and acquiring established players, GroupBy. It's a capital-efficient strategy, but it's risky because it relies on execution. If the integration with Microsoft Azure is clunky, or if retailers don't see an immediate lift in sales, the stock will suffer. Retailers operate on razor-thin margins. They do not have the luxury of experimenting with cool tech that doesn't pay off. Rezolve has to prove ROI instantly. Let's talk about the BrainPower LLM. This is their proprietary large language model. Most companies are just wrapping GPT-4 in a nice interface and calling it a product. Rezolve claims their model is purpose-built for commerce. This is a critical distinction. A general-purpose model might hallucinate a discount code or recommend a product that's out of stock. A commerce-first model needs to be tied strictly to inventory databases and pricing engines. If Rezolve has truly cracked this, creating an LLM that is creative enough to sell but strict enough to be accurate, then the current valuation of roughly $960 million is a fraction of its potential value. However, if BrainPower turns out to be just another wrapper, the market will punish them severely. We also need to address the Interactive Brokers trading crowd and the short sellers. With a float that is relatively small compared to the shares outstanding, the stock is susceptible to squeezes. We saw this on Friday with the bounce from $2.84. The borrow fee on shares for shorting can spike, causing shorts to cover, which drives the price up, enticing more retail FOMO from the Robinhood crypto and stock crowd. It's a feedback loop. But unlike the meme stocks of 2021, there is a real business here trying to get out. The tension is between the meme mechanics of the stock and the enterprise mechanics of the business. For those of you engaging in self-investing through Fidelity IRAs or similar long-term vehicles, the question is whether RZLV fits a long-term thesis. It's certainly not a set-it-and-forget-it play like a Fidelity ETF tracking the S&P 500. This is venture capital in public clothing. You're betting on the management team's ability to leverage the Microsoft and Google channels before their cash runs out. The cash burn is the ticking clock. Developing proprietary LLMs is expensive. Sales cycles in enterprise retail are long. Can they bridge the gap? The recent earnings reports showed growth, but also significant costs. The expectation is that they will run out of cash and dilute shareholders. The reality they're pitching